Gold and silver are collapsing before your eyes. Not slowly, not gently, but in a free fall that's shaking markets worldwide. Gold just broke 4,600, silver plunged to 72, and every few minutes the numbers drop further. Friday was supposed to be the worst, yet the carnage didn't stop. Traders are being wiped out, positions liquidated, accounts erased, all while the media blames market correction. But this isn't random. This is a systematic, coordinated attack on longs. If you're holding precious metals or even thinking about it, you need to see the truth behind the numbers before it's too late. Most people think a market crash is simple. Prices fall, panic spreads, then things eventually recover. But what's happening right now in gold and silver is far from ordinary. Friday's drop, 38% on silver, 16% on gold, was the worst single-day collapse in 45 years. Yet traders believed the worst was over. They were wrong. Orders are being rejected, circuits breached, and margin calls cascade like a tsunami, liquidating accounts one after another. Every single price drop triggers more forced selling, creating a self-feeding spiral. What's worse, the system is trapping traders in positions they cannot escape. ETFs refuse orders, exchanges block exits, and even after a weekend, retail investors wake to frozen positions. Imagine trying to sell 30% of your portfolio and the system literally denies your request. That's the reality right now. Hundreds, maybe thousands, of traders are locked in, watching wealth vanish in real time. And the logic behind this crash? It defies fundamentals. Silver has been in deficit for 5 consecutive years. Industrial demand from solar, EVs, and electronics is exploding. Supply is flat, yet prices are being crushed. How is this possible? Coordinated margin hikes, 8 margin increases in 8 weeks, unprecedented. Each hike forces more selling, pushing the market into a spiral of destruction. Meanwhile, physical demand is exploding. China restricts exports. Vaults are draining. Smart money is taking delivery while retail is panicking. This isn't a normal correction. This is a manufactured collapse designed to liquidate positions before March, when delivery demands will expose the fractional reserve nature of the system. Retail gets destroyed, banks profit, and the true value of metals is hidden from the public. And unless you understand what's happening, you risk being swept away by the same wave. So, what's the secret behind this collapse? Why is gold at 4,500 and silver at 72, while Shanghai physical silver trades at 100? Why does the system refuse to let people sell, while others profit quietly behind the scenes? The answer lies in a combination of margin manipulation, fractional reserve dynamics, and a carefully orchestrated panic. Every hike, every rejection of a sell order, every frozen account is intentional, designed to shake out weak hands. Exchanges like CME and Shanghai are coordinating in ways that should be impossible, 14 time zones apart, yet taking the same actions on the same day. Even more shocking, for every ounce of silver in a vault, hundreds exist on paper. For every 1 ounce in a vault, there are 356 paper claims. This works until someone demands physical delivery. And people are demanding it. 33 million ounces removed from COMEX in a single week. Warehouses draining, trucks moving, security teams mobilizing. Who is taking it? Institutional buyers, manufacturers, sovereign wealth funds, the smartest players in the world, quietly collecting metal while retail panics. This sets the stage for a dramatic revelation. Paper prices don't reflect reality. They never have. The crash you see isn't the real market. It's an artificial engineered collapse to force liquidation. Meanwhile, physical metal holds its value, showing the truth. Understanding this distinction, the difference between paper and physical, is crucial. Later, I'll show you exactly how this manipulation works, who benefits, and what you should watch if you want to survive the storm. By the end, you'll know why this isn't just a crash. It is a battle between artificial prices and real scarcity, and how to make sure you're not on the losing side. Let's start at the beginning of this financial storm. The week opened quietly, almost deceptively so. Traders returned from the weekend believing Friday's brutal drop, 38% on silver, 16% on gold, was the worst they would see. Many thought the market had found a bottom, that selling exhaustion would stabilize prices, but that assumption was dangerously wrong. When the markets opened Monday morning, thousands of investors tried to exit their positions. Orders were rejected. Trading platforms displayed errors. ETFs like ProShares, UltraSilver, and iShares, Silver Trust, could not process sales. Imagine sitting there watching your wealth evaporate, clicking the sell button repeatedly and nothing happens. Your account value drops minute by minute while the system freezes you in place. This was reality for retail traders in the United States, Europe, and Asia. Some tried contacting customer service, only to be placed on hold for hours or longer. Others had to wait days before regaining access. The emotional toll was devastating. Why is this happening? The culprit is margin manipulation. Futures trading allows you to control enormous amounts of silver with relatively little cash. Your margin. 1 hike is manageable. But 8 margin hikes in 8 weeks? That's not trading risk. It's annihilation. The CME raised margins repeatedly, often during holidays like Christmas and New Year's weekend, each time forcing traders to liquidate positions at the worst possible moment. Each forced sale pushed the market lower, triggering more margin calls for other traders who hadn't initially been affected. This self-perpetuating cycle became a death spiral. And it didn't stop with the CME. The Shanghai Gold Exchange mirrored the hikes on the same day, raising margins by 20 to 26%. Coordinated action across 14 time zones is almost unheard of, especially between countries with historically adversarial relations. The reason? Fractional reserve silver. For every 1 ounce of physical silver in COMEX vaults, there are 356 paper claims. The system relies on most traders settling in cash rather than demanding delivery. But physical demand is surging. In mid-January, 33 million ounces of silver physically exited COMEX vaults in a single week, a quarter of their total holdings. Trucks, warehouses, and security teams were mobilized to move this metal. This isn't retail investors, it's institutions, sovereign wealth funds, and manufacturers securing real assets. Meanwhile, paper traders were panicking. ETFs and futures accounts were liquidated automatically, often at rock-bottom prices. Platform freezes, halted trades, and locked accounts exacerbated the chaos. The carnage wasn't limited to the US. In India, Rajkot's jewelry firms reported 44 bankruptcies in a single week, exposing $425 million in losses. Hedge funds in London suspended redemptions, unable to honor investor withdrawals because their silver positions were underwater. In Dubai, premiums for physical silver spiked to 15% above spot, signaling extreme scarcity and demand. The divergence between paper and physical silver is staggering. COMEX silver trades at 72, while Shanghai physical silver trades at 100, a $28 or 39% gap. Paper prices are being manipulated downward. Physical prices reveal reality. This difference is critical. Sophisticated buyers, particularly in Asia, are willing to pay a huge premium for physical metal, indicating they understand paper markets are rigged. Meanwhile, U.S. retail traders are suffering, caught in a system designed to protect institutions and insiders. Let's talk about leverage. Many traders were wiped out, not because they made bad predictions, but because margin calls forced them out of positions automatically. One margin hike might be survivable. Multiple hikes in succession are catastrophic. Traders who survived the first few hikes often fell victim to subsequent ones, unable to cover increasing margin requirements. The CME's switch to percentage-based margins on January 13th made this worse. Now, as silver rose, the margin requirement rose automatically, tightening the trap further. And there's more. Thursday before the crash, unusual options activity appeared on silver ETFs. Massive put buying suggested someone knew a collapse was imminent. Then, false news hit. Reuters claimed the U.S. government was ending support for strategic metals. Algorithms reacted, triggering automated selling before the correction could be announced false. A few hours later, the Energy Department confirmed the report was inaccurate. By then, the damage was done. Coordinated leaks, margin hikes, and automated systems combined to create the perfect storm. This isn't just theory. Traders across the globe experienced it. Some U.S. traders watched their accounts drop 62% in one session. Chinese investors using the UBS SDIC Silver Fund were unable to execute trades all day. Retail investors in Europe and India faced the same nightmare. Locked positions, margin calls, and no way out. Meanwhile, institutions quietly collected physical silver, drained vaults, and profited massively from shorts. The fundamental story is clear. Silver has been in deficit for 5 years. Industrial demand from solar panels, EVs, and electronics continues to rise, while mine supply is flat. China restricted exports on January 1st, reducing availability by 40%. Yet paper markets crash. The message is unmistakable. What is happening in gold and silver is not a natural correction. It is a manufactured event designed to eliminate weak positions, concentrate wealth, and set the stage for a confrontation between paper and physical. And here's the kicker. This system is designed to recover. Paper prices eventually reconcile with physical, but not before transferring massive amounts of wealth from retail traders to institutions. Some traders survive and profit, others are wiped out. The difference isn't luck, it's awareness, risk management, and preparation. As of now, gold trades at 4,500, silver at 72, and physical silver in Shanghai at 100. Platforms remain stressed, margins remain high, vaults continue to drain. The market is screaming signals that few understand. Observers must focus not on price charts alone, but on margin movements, physical flows, and lease rates. This is the full story of a market under engineered stress, one that most traders have never experienced and one that is shaping the next chapter of the precious metals world. Here's the truth behind what you seeing. This crash isn't a normal market correction. It's engineered. Every sudden drop, every margin hike, Every frozen account is part of a systematic design to shake out positions and consolidate wealth in the hands of those who control the exchanges and the shorts. The paper price you see on COMEX, silver at 72, is being manipulated. Meanwhile, physical silver tells a completely different story. In Shanghai, the same silver trades at 100 per ounce. That's a $28 gap, nearly 40% higher. This divergence is your clearest signal. What S on the screen in New York does not reflect reality? Why does this happen? Fractional reserve mechanics. For every ounce of silver in the COMEX vaults, there are hundreds of paper claims. The system works until a significant portion of holders demands physical delivery. That's when the math explodes. In January alone, 33 million ounces physically left COMEX vaults, 26% of total holdings. Trucks, warehouses, and security teams were mobilized to move this metal. And it wasn't retail investors taking it. It was institutions, sovereign wealth funds, and manufacturers who understand that physical silver cannot be printed. Meanwhile, margin hikes and automated liquidations force smaller traders out of positions. One hike may be survivable. 8 in 8 weeks is catastrophic. Each forced sale drives the paper price lower, which triggers margin calls for other traders, creating a self-reinforcing downward spiral. Exchanges like CME and Shanghai coordinate actions across time zones to protect the system and force these liquidations. The panic spreads algorithmically. False headlines, leaked announcements, and unusual options activity amplify the effect. Retail investors suffer while institutional shorts, like JP Morgan and Bank of America, profit billions. The disconnect between paper and physical is not temporary. It's a signal of the system's fragility. Lease rates on physical silver have spiked to 10%, 20 times normal levels. That's not speculation, it's desperation. Institutions are paying a premium to borrow metal because it's scarce, not because it's about to get cheaper. The physical market is screaming the truth. Demand exceeds supply, scarcity is real, and the crash you're watching is artificial. Here's the critical takeaway. Crashes like this don't destroy wealth, they transfer it. The wealth lost by retail traders today is being absorbed by institutions positioned for this exact scenario. Paper silver will eventually reconcile with physical, but the timing and scale of that reconciliation determine who profits and who loses. The Shanghai premium, vault levels, and lease rates are the indicators you need to watch. They reveal the truth that paper prices hide. In short, paper silver is collapsing, physical silver is holding, institutions are collecting, and retail traders are being liquidated. This is not a market accident. It's a calculated operation to protect fractional reserves, force liquidations, and mask the true scarcity of the metal. Understanding this divergence is critical if you want to survive and potentially benefit when the market finally realigns with reality. The truth is hiding in plain sight. You just need to know where to look. Now ask yourself, where do you stand in all of this? Are you a passive observer, watching the chaos unfold on your screen, or are you actively tracking the signals that reveal the market's hidden truth? The paper price of silver may be collapsing, but physical metal tells a completely different story. Gold sits at 4,500, paper silver at 72, and Shanghai physical silver at 100. That gap is screaming for attention. Don't focus only on charts or price targets. Focus on the fundamentals the media ignores: vault levels, lease rates, margin hikes, and open interest for March delivery. These numbers reveal who is winning, who is losing, and where the real pressure lies. Platforms freezing, accounts being locked, and ETFs halting trades. These are warning signs, not coincidences. Every spike in lease rates, every ounce leaving a vault, every delayed order tells a story of scarcity and manipulation. Take action, not in panic, but in preparation. Review your positions, assess your risk, and understand your exposure. The difference between survival and ruin in this environment isn't luck, it's knowledge, timing, and discipline. Share this information with others who need it. Discuss it, question it, track it daily. Markets like this reward the observant, the patient, and the informed. The price of silver today may scare most traders, but understanding the hidden mechanics behind the collapse puts you ahead. Awareness is your first line of defense and your first step toward turning chaos into opportunity. Remember this: gold at 4,500, silver at 72, paper is falling, physical remains strong, margin hikes continue, vaults drain, and institutions are quietly collecting. Every forced liquidation, every frozen account, every spike in lease rates tells the same story. Paper is manipulated, physical holds the truth. History proves it. Every time paper deviates from reality, eventually physical wins. Crashes do not destroy wealth, they transfer it. The question is whether you survive until reconciliation. This loop repeats: panic, forced liquidation, manipulation, recovery. Those who understand the mechanics profit, those who ignore it lose. Track the data daily. Shanghai premium widening means paper is losing credibility. Vault levels falling means scarcity is real. Lease rates spiking signal urgent demand. These indicators are more important than any price target. The market will correct eventually. When it does, you want to be on the right side. The lessons of 1980, 2011, and now 2026 are clear. Know the fundamentals, know the difference between paper and physical, and never underestimate systemic manipulation. Survive, observe, and act wisely. Gold at 4,500, silver at 72, physical at 100. The gap is screaming the truth. Are you ready to see it clearly?